How do you identify a business with a long growth trajectory at a reasonable price? We see if we can answer that question with the Nick Sleep lads, and an example of Costco. Nick Sleep and Zach Zakia formed Nomad Investment Partnership and had 921% returns between 2001 and 2014. The MSI over the same period had 117% return. They bought Costco in 2004 at around $30 per share. While writing this, Costco is now $540 per share. So what did they see in the business that others couldn't? We have a look to see how Nick appraised the business and to see what insights and techniques we can apply in our own investing. Costco is a membership-based warehouse retailer that offers high-quality goods at a very low price. So already that can tell us that membership is going to be an important factor, as well as the amount of Costco warehouses, their location and distribution. In 2004, there were 42.4 million cardholders. Membership renewals were strong at 86%. But what was it that was pulling in those members? What's responsible for the high renewal rate? Costco's competitive advantage, or its moat. The answer leads us to their pricing model, which Sleep spends some time emphasizing. Products in Costco stores only have a 14% markup above the base price. This is referred to as the everyday low pricing strategy. This differs compared to the big supermarkets that have margins double that, with the exception of Walmart at a 25% markup. Nick then points out competitors tend to want to funnel customers to certain products using sales, what Nick Sleep terms a high-low strategy, which describes the effect of price changes in products, whereas Costco is consistent in its low prices. So as the company expands, opening new stores, the ability to buy more inventory at cheaper prices than previously allows for those potential higher profits to be passed on to the consumer because of the 14% markup. This actually has the effect of benefiting older stores because of the even cheaper products, allowing for further growth in those stores. Nick dubs it scaled efficiencies shared. Easy to understand and hard to operate is how Costco management has deemed their strategy when it comes to their low prices. This is because the temptation is always there to increase profits in the short run by increasing the markup. This, however, could lead to Costco impairing its reputation for great value with its customers in the long run, and as such, eating away at its moat and durability. An example of this temptation in effect was the following story related in the Nomad letter to shareholders. Costco bought 2 million designer jeans from an exporter and shipped them into international waters, and re-imported the jeans for an all-in price of $22 per pair. This was $10 less than the firm had sold the jeans for in the past, offering a potential for a 50% markup, and half the cost of most other retailers. One buyer recommended taking a higher gross margin than was usual, i.e. more than the usual 14% markup, as no one would know. Apparently, CEO Jim Signal insisted on the standard markup, arguing that if I let you do it this time, you will do it again. To further guarantee low prices from suppliers, that's the base cost, within each store there are only 4,000 items or lines, limiting the shelf space for products. Those shelf spaces are then auctioned off to different suppliers. The winner is the supplier who provides the greatest value product. So there's not only incentives for the supplier to provide the product at cheaper prices, there is also a disincentive to start with higher priced bids, as Costco will discontinue to use sellers that continuously do not start with the lowest prices. So we've identified its competitive advantage, and the whole business is structured around it, but there's still questions about potential to grow, and how the business is funding that growth, not to mention figuring out the business's value. Thinking about growth in a business like Costco. Another aspect of Costco's business is that they purchase stores outright rather than renting. This means growth isn't as fast as other businesses, but it also makes Costco more sustainable. A further positive aspect of the business is that management have admitted to always underestimating saturation within areas. An example of this being in LA in 1993. They thought 31 stores would be too many. In 2004, there were 36. It also mentions within the letter that in Alaska and Seattle that membership penetration is in 65% of households. Outside in other areas, it's around 10%, so there's plenty of room to grow. As per the 2004 annual report, we feel confident given that recent successes and market conditions, we should be able to double our present number of warehouses over the next 10 years, given the combination of US and international opportunities. So when Nomad were originally looking at Costco and trying to determine the value of the business, they thought the stock looked cheap in comparison to the market price. Why were the other investors and institutions getting this wrong? Why couldn't they see Costco's potential? Within the Nomad letter to shareholders, Nick outlines the following reason. Number 1, the company has low profits of 1.7 compared to the likes of Walmart at 3.6, or Target at the time of 4.2%. Nick responds to this by saying, "True, but that's the point. The firm is deferring profits today in order to extend the life of the franchise. Of course Wall Street would love profits today, but that's just Wall Street's obsession with short-term outcome." This might seem a somewhat counterintuitive point made by Sleep. But again, the company is passing on those profits to the consumer in the form of low prices. This makes Costco in the longer run very hard to compete with, and as it expands, so will its revenues and thus its longer term profitability. 2. The second reason for the lower market price is investors' attitudes to the higher price to earnings ratio. Sleep discusses. It's expensive at 24 times earnings. Really? Net income is a small residual, as discussed above. The firm could earn Walmart margins by taking the pricing up a little, in which case the firm would be on 11 times earnings. But would it be a better business as a result? We think not, if it allowed the competition to catch up. So investors often use the price to earnings ratio to give them a quick idea of if the company is expensive. Again, this business competitive advantage is its low margins, and that's what's making this business successful at its core, and what's allowing it to eat up market share. That doesn't excuse every company with a higher PE ratio either, it's about understanding the context. 3. Reason 3 is Costco has a cost problem. This was true and identified by the CEO and company founder, Jim Signal, in the 2003 annual report. While our fiscal 2003 sales and margins were fine, our operating expenses as a percent of our sales continued to climb, increasing from 9.41% in 2002 to 9.83% in 2003. For the past 3 fiscal years in the aggregate, our operating expenses as a percent of our sales are up 112 basis points. These figures are unacceptable, and we're working hard to reverse this trend. They identified several ways to reduce these expenses, including enlarging the employee's contribution to healthcare benefits, taking steps to reduce inventory shrinkage, and minimizing general selling and administration expenses. Indeed, in 2004, these were already being addressed. SG&A expense was reduced by 0.8%. So Nick spent time understanding the business, looking at whether it had a competitive advantage, scoping out the company's potential to grow, trying to understand why the market and other investors didn't value the company like he did. He goes on to look quickly at the financials, but the conclusion is Costco has pretty nice amounts of free cash flow. And this is a good thing because it means the company can finance future growth itself. It doesn't need to take on huge amounts of debt or issue more stock, which would have the effect of devaluing the current shareholders' stocks. It's easy to demonstrate why by taking earnings per share. If you look at the company's current earnings and then were to divide it by the number of shares outstanding, that would give you the earnings per share. If the company then issued more shares and the earnings stayed the same, it would dilute your earnings per share. That is, the earnings per share would go down. So when trying to come up with the valuation of a company, the most important variable is the growth rate. You have to use the assumption of how much each year the company is going to grow. With Costco, Nick looked at the individual store growth, finding the older stores are still growing and have almost double the revenue of the newer stores. Essentially what he does is groups the stores into 3 buckets. Old stores, which were still growing at 3 to 4%, somewhat new stores, which needed to catch up to their older counterparts by 4%, and brand new stores, which add approximately 5%. So that's an estimated growth rate of 13%. So here's a few takeaways. Look for the business's competitive advantage. In the case of Costco, it was its low prices, which as it grew, became lower due to the increasing volume of product purchased at a cheaper per unit rate from suppliers, whilst keeping the same margin, making the product cheaper for customers. Look for opposing arguments about the business in case there's something you've missed, especially if the price seems to be low. Look for how the business is planning to grow and how it is done compared to previous years' forecast made in the annual report. If the business is a physical retailer or has storefronts, compare the newer stores' returns to the older stores. And finally, how is the business planning to finance future growth? Will it have to take out more debt or eat into its equity? Or can it sustain its growth via its free cash flow? I hope that gives you plenty to think about. If so, consider leaving a like or subscribing. I'll put the full link to the text in the description below for those of you who haven't read the letter and are interested. Cheerio.